From our earlier discussions, we understand that the planning and control functions are crucial for monitoring the performance of employees and departments within an organization, especially those managing financial data. It is therefore vital to know how major corporations structure their accounting and finance teams. Imagine you are the CEO of Athletic Apparel, Inc., which manufactures athletic wear and equipment for sports enthusiasts. Assume it is a sizable publicly traded company, meaning its shares are available for purchase by the general public on stock exchanges. As CEO of Athletic Apparel, you might ask several financial questions. How much income tax does the company need to pay this year? What was the total net income for the previous fiscal year? Is it advisable to expand into new regional markets? If we decide to expand, should we raise funds through bond issuance, secure a bank loan, or issue more common stock? What are the profit margins for different segments of our business, such as athletic wear and sports equipment? How effective are our internal controls over cash management? To find answers to these questions, it's important to know which member of your finance team to consult. An organizational chart can be instrumental in identifying the right personnel for each query. This organizational chart outlines the typical structure of accounting and finance departments within most corporations. The chart depicts a hierarchical setup where personnel at lower levels report to their superiors. For instance, a managerial accountant would report directly to the controller. At the pinnacle of the organizational structure are the primary decision makers, usually the board of directors, who are appointed by the company's owners or shareholders. These top-level directors oversee the broader strategic direction and governance of the company. The Chief Financial Officer, CFO, is responsible for overseeing all financial and accounting operations within the organization. This senior executive typically reports directly to the Chief Executive Officer, CEO, ensuring that all financial strategies align with the overall objectives and policies of the company. The controller plays a crucial role in managing the accounting team, which is responsible for delivering essential financial information across three key areas: managerial accounting for internal decision-making, financial accounting for external reporting, and tax accounting to comply with tax filing obligations. Under the controller's supervision are three specific types of accountants, each specializing in one of these critical areas. The managerial accountant, reporting directly to the controller, plays a vital role in preparing data that aids in internal decision-making. This accountant is responsible for generating several reports, including operational budgets, cost estimates for current products, budgets for new product initiatives, and profit and loss statements by division. It's important to note that while some may use the terms managerial accountant and cost accountant interchangeably, others view cost accounting as a specialized subset of managerial accounting focused primarily on cost measurement. In this context, we refer to the role as managerial accountant and consider cost accountants as specialists in measuring costs within the broader field of managerial accounting. The financial accountant, who also reports directly to the controller, is responsible for preparing financial statements and reports in compliance with U.S. Generally Accepted Accounting Principles, GAAP. These reports are intended for external stakeholders, such as investors, analysts, and regulatory bodies. Key documents produced by the financial accountant include the quarterly 10-Q and the annual 10-K reports, both of which are filed with the Securities and Exchange Commission, SEC. These documents provide a comprehensive overview of the company's financial status and are essential for maintaining transparency with the public and fulfilling regulatory requirements. The tax accountant, under the direct supervision of the controller, specializes in preparing tax-related documents for government agencies, notably the Internal Revenue Service, IRS. This role involves calculating, filing, and ensuring compliance with various tax obligations, making it essential for maintaining the organization's legal and financial standing. The treasurer, reporting directly to the Chief Financial Officer, CFO, holds a key position responsible for managing the organization's financial resources. The primary duties of the treasurer include securing financing for the organization from various sources, such as banks and shareholders, forecasting cash flow requirements, and managing the company's cash holdings and short-term investments. This role is critical in ensuring that the organization has the liquidity to meet its operational needs and strategic objectives, while also managing financial risks effectively. The internal auditor is a critical role within an organization, reporting directly to the Chief Financial Officer, CFO. This position is tasked with verifying the integrity and accuracy of the company's financial data. The internal auditor ensures that effective controls are in place to provide reliable financial information and regularly checks the work of the managerial, financial, and tax accountants, all of whom report up through the controller to the CFO. In situations where conflicts or significant issues arise involving the CFO, the internal auditor has the authority to report directly to the board of directors or to a specific audit committee made up of selected board members. This direct line to the board ensures that the internal auditor can maintain independence and objectivity in overseeing and assessing the company's internal controls and financial reporting processes. In smaller organizations, the structure depicted in a typical organizational chart may not be fully applicable due to scale and resource constraints. In such settings, the finance and accounting functions might be consolidated among fewer staff members. For instance, it's common for one accountant to handle both financial and managerial accounting responsibilities, while another might manage tax-related tasks, or these might even be outsourced to a specialized tax firm. Instead of maintaining an in-house internal auditor, smaller organizations often engage external consultants to perform auditing services. Moreover, the roles of high-level executives like the CFO and controller might be combined or assigned to a single individual. Or in some cases, smaller organizations might not appoint a CFO at all. The organizational structure of a small business is heavily influenced by various factors, including its size, operational complexity, and specific reporting obligations. This flexibility allows small organizations to adapt more readily to their unique circumstances and resource availability.